Howdy, folks. Welcome to the Daily Coin. My name is Rory, and today is Friday, October the 9th, 2020. I have the great honor and very distinct pleasure of welcoming back to the show a gentleman that I hold in very high regard, and he works for an unbelievable company that was founded by a gentleman that we all know and respect, Mr. Keith Neumeyer, who is the founder of two different billion-dollar companies, and I firmly believe that he's on his way to his third with First Mining. And we have on the line the CEO and director of First Mining, Mr. Dan Wilton. Dan, welcome back to the Daily Coin.
Oh, Rory, it's a pleasure to be back, and thanks for having me back. It's much
Well,
appreciated.
I'm glad that you're here. I'm going to do a share screen here, so we're going to switch over to that real quick. Let's see what we got going on here. All right. And want to just jump in. I wanted to ask you, Dan, about inflation. We know that Jerome Powell's been making a lot of noise recently about inflation, and you and I both suffer under the inflation that he's looking for. And gold over the last year has gone up quite a bit. And the last time that you and I spoke, you were talking about $1,500 gold being a boon for the miners. And here we are in the neighborhood of $2,000 gold. And what does that, with the inflation that's coming, with the price of gold that's happening right now, what impact do you see all of this having on the mining sector and gold in general?
Yeah, it's interesting, Rory. When we chatted last time, as you say, the gold price was just kind of ticking up around 1,500, and we were talking then about the impact to the free cash flow of the gold sector, right?
Yes.
The average, we'd call it average all-in sustaining cost in the gold sector would be about $1,100. So at $1,300, you're getting $200 margin. At $1,500, you're getting $400 margin.
Yep.
You know what's even better than that? $1,900 or $2,000 gold, right? Like, the reality is, show me another business in the middle of a pandemic that's going to generate 5 times its free cash flow, right? Without having to invest more in its business. That's the leverage that the producers right now are having to this increase in gold price. So, and what a lot of people don't remember is that push up in the gold price from 1,300, really, we're like a year into gold prices above 1,300, right? It started pushing in June of last year.
Right.
So we've only seen 4 quarters, and we haven't seen any quarters of gold at $2,000, right? And how that's going to actually translate into the cash flow of those that are producing and selling gold. So I think there's kind of 3 or 4 logical building points when you're thinking about an investment thesis in gold that I like to go back to. Number one, where's the gold price going? That comes back to our inflation discussion, right? And what you basically have is not just the Federal Reserve, but literally every central bank in the world, certainly in industrialized economies, pumping a virtually unlimited monetary stimulus into the markets, right? Unprecedented. $20 trillion it's been estimated so far that's been put into the markets. And and so far what that has shown and what it's done for us all is that it's not enough, right? It was enough to kind of only have 10% unemployment, right? Just to put it in context. But it's not enough to kind of keep the economy going forward. The real economy is in trouble, and what's going to hurt the real economy ultimately is what the result of pumping all this money into the economy is, and that's going to be inflation, right? So when the Fed gives up, really for the first time in 40 years, they've announced they've given up on inflation targets. That's just such a monumental shift. That's a once in a generation shift in monetary policy strategy. And no one's really talking about that. And they're not talking about it because no one really wants to accept the fact that the only way we're going to pay for all this stimulus and get ourselves out of it, not just monetary, but fiscal stimulus as well. Like you can't increase tax that much on populations.
Right.
You know? So the only way we're going to get out of it is inflating this debt away. And we'll inflate the debt away by keeping asset prices reasonably high. We keep asset prices high by keeping interest rates low or negative. And that's where we are right now, right? This is in a real basis. In every industrialized economy in the world, on a real basis, we're in negative interest rates. So, yeah, it's unprecedented times. What does that mean? It means over years with this inflation, your savings are going to struggle to keep pace with it, right?
Yes.
You know, negative real government bond rates means that, you know, you're paying the government to hold your money, which is kind of not how that's supposed to work.
No,
that money flow is
no.
supposed to go the other way for savers. So in the end, you know, as we come out of these unprecedented times, how do you deal with it? I don't know. But I think, you know, there's got to be a greater focus on real assets. And I know that, you know, in my life as a private equity fund manager, a lot of our limited partners were big corporate pension funds and university endowments in the US. And they've been very proactively thinking about real asset allocation for a long time, but it's a small percentage of their portfolios. So you just think about what happens when, you know, a few multi-billion-dollar pension funds decide that, yeah, they're going to increase their exposure to physical gold, or they're going to increase their exposure to gold miners. You know, that amount of capital coming in is going to be significant and should argue for, you know, higher rates. Not to mention, your broader generalist investor pretty soon is going to be looking at quarterly performance or annual performance of subsectors. And they're going to see the materials sector has been going gangbusters, particularly in sub-indices like in the TSX where you have a gold sub-index. So it's going to be one of the top performing sub-indices. And so then the generalist investor will start chasing it. But all that is to say, the gold miners are pretty well set up here, generating a ton of free cash flow.
That they are right now. And you guys have a boatload of cash that's sitting on your account. So going into your next phase, which is coming up, yeah. You guys are in really good position to take the next step. And you mentioned something that I wanted to ask you about, and that is the pension funds coming into the market. I mean, we just recently had a pension fund to enter the gold market, to say nothing of Warren Buffett making, you know, his big splash a month or so ago, or 6 weeks ago, whenever it was. And I personally believe that this is going to be a trend going forward, that there's going to be one or two smaller funds probably come in, and then one or two of the bigger funds are going to jump on board on the early side of this, and they're going to get into the miners. They're going to get into physical. I mean, is that not what your analysis is showing also, Dan?
I think so. And I listen, and I think for every investor who is sitting wondering how they manage their portfolio through these unprecedented times, you know, I'm not saying you put 100% of your savings into physical gold or 100% of your savings into gold equities, but you should think about having a larger percentage in it, right? Yeah. It just provides some of that counter-cyclical protection in an unprecedented time when we don't really know what's going to happen to banks and some of the other traditional kind of fixed income type investments.
Right, and you made mention of something that I really want to kind of put a fine point on, in that you've heard it, I've heard it, anybody in the gold sector has heard it our whole lives, the whole time we've been involved with gold. Gold doesn't pay a dividend. Well, guess what? It doesn't steal from you either. And that's exactly what's happening to people that are in the bond market. that have assets that are tied to the that are tied to inflation, which everything is. I mean, we have zero interest rate policy. Zero. It's a goose egg.
Mm.
So if you put even 1% inflation on top of that, that's a 1% loss. 2% loss. 3, whatever the number is that the inflation is, that's what you're losing.
Yeah.
You're not losing that in gold, right? So I mean,
No,
equities would be, gold stock equities would be the way to go. I mean, as far as being if nothing else, it would be an offset to that.
Yeah, listen, I think you're going to continue to see really robust cash flow going into the producers, and some of them are starting to pay actually reasonably sizable dividends, as investors are asking them to. So that's an important part of it. But a nice segue to why you think about owning a First Mining is that what you need to also understand in each of those companies that you're going to be looking at is what are their long-term reserves like? What's the mine life like at their producing operations? Because what a lot of us conveniently forget about this business, and I've been in this business, financing mining companies and doing mergers and acquisitions around the mining sector since the early 90s. What a lot of us conveniently forget is that this is an extractive industry and your reserves are in the ground until you take them out, and then they're not there anymore, right? Like when you produce an ounce of gold, it's not on your ledger as resource or reserves anymore. So you need to spend money to replenish that, either through exploration, which is becoming increasingly difficult, or you need to go buy other resources. And that's the part of the sector. What a lot of people who are just now starting to focus again on the gold sector don't appreciate is just how little capital investment has been made in this sector since 2012. And there's some really good reports that S&P has done that actually shows the decline in capital investment and in exploration spend in the sector. And it's, the difference in the last upcycle in 04 to 2011 with that little speed bump called the global financial crisis in 08, 09. The difference between now and then is that then you had the accumulated stock of 30 years of reasonable investment in the sector when you were starting a bunch of these projects in 04, 05, which, some got skated onside economically by a higher commodity price. You don't have that at all today. You've had active disinvestment in project development. You've had, large companies selling development projects or shelving them or just shutting them down from basically 2012 to 2019. So 7-8 years of disinvestment. And now all of a sudden they're looking at their mine lives, which average life of a mine when you build it in this industry is 10 years. Average mine by definition would be, somewhere around halfway through its mine life. So you start seeing a precipitous fall off in the productive capacity of the industry in 5 to 10 years time. In 10 years, it's actually dire, right? In 10 years, without more investment, this industry would produce less than half of what it produces today. Just think about that. 40 million ounces of gold a year. You're not going to have the productive capacity to deliver unless there's more spend in project development. So these resources, which have been ignored because no one was spending money on development really since 2012, and that was the thing that Keith saw in 2015 and 2016 when they started this company. People had just given up, and they were 4 years into a bear market. They hoovered up all these really interesting projects at rock bottom prices. That's our portfolio today. You couldn't do today what Keith and the team did in 2015, 2016, because it would cost you 10 times as much. They were buying gold for $10 an ounce. The average developer today trades at 90. So, for us, that's given us this unbelievable endowment of projects that we've now started moving down the path with our Pickle Crow project, where we found a great partner who's spending $10 million, earning into 80% of it, with our Gold Lung Goliath project, where we sold Goldland into Treasury Metals to take a big equity stake in Treasury and a royalty on the project. And, that's now kind of moving independently, but it's moving toward a construction decision. I think that's going to be a really interesting and robust project that the Treasury teams in the project is scoping now. Should have some visibility on that kind of end of the year, early next year. And then, we still have beyond those two, another 4 projects, including Springpole, which is kind of our flagship project, which is one of the largest undeveloped open pit gold projects in Canada, and one of very few projects in the world capable of producing in excess of 300,000 ounces a year. Located as you see it there, right in between, about halfway in between 2 great historic mining camps at Red Lake and Pickle Lake. One of the hottest exploration areas in the world right now when you look at some of the great results that some of the Red Lake explorers have been having. And we've got a huge land package right in the middle of it with a 5 million ounce deposit that today in our share price reflects, less than $100 million. I would tell you, if you give any value to the rest of the projects in our portfolio, you're still getting Springpole for free. It's remarkable. We're in a remarkable time here. So, in a market where a lot of these gold developers have gapped up and, explorers, you have one good drill hole, all of a sudden company's got a 250 million market cap. You can still find value and real fundamental value. And listen, that's the reason I joined this company, is because it looked at these projects as a private equity investor. And I knew there's real fundamental value here. We just needed to round out the team, make sure we had enough financial stability to get ourselves to the starting line, not even the finish line on the project, but on the starting line, so that we have permits and people understand that we can build it. And I think this really robust project.
And I want to ask you about that, because last year we saw some of the big boys get after some mergers. There was some you had Barrick and Newmont and Goldcorp. They were all merging together, and at that time, I said that this is a result of the previous 10 years, 15 years of the fact that what you were just talking about, Dan.
Yep.
There's been little capital inflows, and the research and development just hasn't been there. And as you so aptly pointed out, you take an ounce out, well, that resource is now gone.
Yeah.
It's not like you can replace it. It's not like you can manufacture another. You have to go and find another.
Correct.
So do you see these projects as being something that's set up? I imagine that there are people beating down your door right now trying to have a conversation with you about where you're at and what you're doing and so forth. I mean, is that kind of the direction that you guys are moving in, is for one of these guys to come along, or are you wanting to take it all the way to the starting line and develop it out from there?
That's an interesting question, Rory. And the answer is, I think we need to do what we can to take risk out of these projects and do that within what we have as the scope of our financial and human capital inside our company and the experience of our team. And I think we have a team that is able to get these projects through their permits, right? And through demonstrate a really robust pre-feasibility study, which will be coming out early next year, and then roll right now into a feasibility, full-blown feasibility study. We can do a bunch of the advanced engineering to take risk out of the projects, potentially even get so far as starting to think about how we're developing some of the infrastructure around the area. But we're well set up now to get this to that point of what I think is the maximum value prior to construction, right? When you have the project, you have your permits and you have your social license, the ability to move it forward. That to me is kind of the time at which you assess partners and you assess, what's the right method to move these projects forward. So, when Keith and the team set the company up as First Mining Finance, it was always an intention that you'd find partners for the big projects.
Right.
history hasn't been really kind to single asset developers who've tried to take on billion-dollar projects. It's worked in some situations, Osisco being a good example, and that's, spawned another generation of companies. But, for us, I think we're well set up to go down that path to get it to that point. And I think you really assess the value at that point. But between here and there, yeah, you got to have an open door. You got to make sure that that you have the opportunity to demonstrate this robust project to a number of potential partners. So yeah, I think, you need to, this is an industry that you can't just sit and hide. You need to, really be kind of collaborative and open, because every potential partner you have come and look at your project is someone else who can give you a good idea about something that you haven't thought of, because generally these big companies have really, really good technical teams who can, be the best free consulting you can ever get. So, I think we've seen a step change in that kind of activity from 2019 to 2020. And the reality is most of the business development groups of big companies had no budget until November of 2019 or December. They got budget for 2020. They just started rolling up their sleeves and looking at all the projects that they like. And then COVID hit, and all of a sudden they can't travel and you can't go see projects anymore. And, you're back to kind of desktop work, and everyone just kind of hunkered down. So we're now coming out of that. I think one of the big advantages that we have is that when you're thinking about it from the perspective of a bigger company, the first places you're going to look are in the best jurisdictions, right? And our projects are in the best jurisdictions in the world. There is not a better place to build mines than Canada. I think there's not a better place to permit mines than Ontario. They've got a great track record of permitting big open pit mines, 4 big mines in the last 4 years. And where we are in Northwestern Ontario, it's a great resource economy. And our local communities participate in resource development. And, the towns around us are built on resource development. And people who don't mind going out to work outside when it's minus 40, right? This is a great place to be moving projects forward. So no, we're very excited about that.
And how do you see, you mentioned the situation that we have with this virus going around and impacting economies of the world over. And we kind of touched on that a little bit with the pension funds and where the inflation and all that. But more specifically, Dan, what is your analysis pointing towards going into 2021 and beyond, as far as what you see specifically in the gold sector, as well as silver? Because as you know, silver is a big deal for not only for Keith Neumeyer and First Majestic, but for what the projects that you have going on as well. I mean, so where can you talk a little bit about silver as far as giving us what you're seeing with that particular market?
Sure, and I'm not a silver expert. I'll be the first to admit that. I'll leave the prognostications on silver to Keith. But I know he'll tell you that he thinks it's going to be triple digits in the next 5 years for sure. Well known for that call. We watch silver a little bit more closely now than we used to, because we're shareholders of First Majestic by virtue of our silver stream. Part of the payment they gave to us was Majestic shares. So I've been watching it, not minute to minute, but certainly week to week over the course of the last few months. And, I think I'm a big believer in the gold silver ratio. From a career full of financial analysis of mining companies, I think it's proven to be a pretty reliable reversion to the mean around between 60 and 70 over the years. And so as I think about what's going on, that where I saw the biggest potential in silver, when you were sitting in March and silver selling down, below $15, and the gold price started moving, there was that period in like May and June where, Keith called it absolutely perfectly, where they held back selling some of their production at Majestic at 15 and sold it, a month or 6 weeks later at 25 to 27, right? So I think silver, if you believe where the gold price is going, and to start there, historically you've seen kind of trough to peak gold price movements of 5 to 7 times through a cyclical rally. And you think you go back to 2000, 2001 as really the last trough, 250, 260. It was kind of testing below that $300 reasonably long-term level through the 90s. That was kind of the floor for gold. And as I often, have been pointing out to people in the last few weeks, like how much do people really remember May 2006 as a watershed moment in the gold market where gold came up above 650? The answer is no one has that as a benchmark. Why would you? The answer is you would, because other than a couple of trading days with a spike, if you're looking at kind of rolling averages or monthly averages, the gold price hadn't been that high since 1980. And so in 2006, broke a 25-year high going up above 600. And people said, oh, this feels really toppy. It's kind of 2 times above that long-term floor. It's kind of the area where you'd expect to see it pull back. And, everyone was wringing their hands saying it might stay a little bit higher for a little bit longer, but I don't know about that. And then in the next 5 years, it tripled from there, right? So 6 times, again, 6 times cyclical floor to peak. And if you look at what the real floor is in the post-2011 pullback, it's a very firm, call it 1050 or 1100. 1050 would be my 250 analogy. 1100 would be my $300 long-term. Tested it a couple of times on the way down. And we're now sitting not quite double that, $1,100 new cyclical floor. So is there any reason why it can't go up, to 5,000 or 6,000 from here? No, I don't think there's any reason at all. I think we're right now at the point where everyone's wringing their hands saying, oh, it feels kind of toppy. It's double, $2,000 gold is double that long-term, that long-term floor. And the reality is it went up to 1,900 because if you can remember this, heaven forfend, in 2010, 2011, the United States government was going to run unprecedented, other than wartime. They're going to run a $1 trillion deficit. Rory,
a whole trillion.
we started pre-pandemic with $1 trillion deficit. That was the beginning. And then they started shoveling money out the door, and then they started unprecedented fiscal stimulus, right? Like it's,
yep.
We're this economic crisis that we are in, makes the global financial crisis of 2008 look like a speed bump.
And that's something that wasn't happening back in 1980, wasn't happening in 2006. It wasn't happening until like 2010. So all of the history before 2010, before QE was born,
yeah,
and this unlimited QE to infinity became a reality on top of zero interest rate policy. None of that was factored into the $650 gold. None of it was factored into the 1050 gold. It wasn't. It wasn't there.
No, absolutely not.
So is $6,000 gold or $5,000 gold out of the question? Not in my opinion, because gold has a very specific job to do, and that's to say the economy is healthy or the economy is not healthy. That's its job. That's what it does.
No, for sure. And I think, there's a broader range of what you'd classify as real assets that can help play that kind of protecting role. And you see it in low interest rate environments. You're seeing real estate prices go up because it's an affordability issue. People still have cash flow. So, you can stretch your mortgage to infinity if it doesn't cost you anything to borrow money, right? Because you can afford the monthly payments. Now that's not sustainable.
Right.
So I think real estate as far and away the single largest sort of class of real assets is vulnerable. But if you look at other commodities, they'll keep pace, right? At some point, we're all, as the price of your iPhone inflates, the price of the, components and metals that are going into your iPhone is going to inflate as well. The price of everything that you buy that has, some mined component, which, unless you're eating it, and even sometimes if you're eating it, you probably have a mined component in every physical good that you buy. So, it's just going to continue going up. So you're going to see cost inflation. People's wages are going to continue to inflate. So year on year, you're not going to feel that much less wealthy. It's, if you're still earning, I think that's going to be fine. It'll be harder to save money because you're always going to be chasing inflation on the way up. So I think, inflation is a real claw on two fronts. It's a real claw on wealth and accumulated wealth. And it's a real claw on the poorest people in your country who are really struggling just to try and keep pace because, they're barely above water. And when the prices of everything are going up 5 to 7% a year, every year it gets harder to stay above water. So that's where there's the real kind of cultural risks come out of this. But the biggest part of it is, Rory, we haven't even started having the grown-up discussion about how we are going to pay for all of this stimulus, right? And I'd ask you this question. Yeah, listen, I live in Canada. So, we can be a little bit of an impartial observer kind of coming through an election that you guys are having here in the next month. But coming out of that election, what's the likely outcome? And a lot of people have asked, what's the likely outcome for gold and silver? And there's no situation in which you're going to see something that's going to be bad for those two metals coming out of this.
Yeah, I don't think either candidate is going to be a bad situation for gold. I don't think whether Biden or Trump, if Trump is reelected, I think that'll be positive. I think that if Biden is elected, it'll be super positive.
Yeah.
I mean, that's the way that I see it because, Marxism and gold, they're
people are probably going to want to protect their assets a little bit more. So
probably so.
where your risk is in an election is if you're looking at U.S. domiciled projects. That's where I would be nervous.
Yeah.
Where you need some accommodation of the EPA and or permitting, BLM permitting, projects in Nevada, projects in Alaska. You just, you want to be cautious with that. And, you'd kind of hope that everything comes through and those projects can still move forward. But that if you get a Democrat president, then you are going to have more restrictions on mine development in the U.S. But those that are already producing, it'll be great. And, I think certainly the commodity price is going to see even more of a run. So.
Yeah, and I think that you guys are once again, I think that you're well situated to what's actually happening, and you have a ton of free flow of cash on hand,
yep.
And you've got these reports that are coming out in the first part of next year, so things are looking really good from my perspective for what you all have going on.
Yeah, no, I think we're in a very different position than the company has ever been in. We've got in excess of $60 million of cash and liquidity. We're likely to have another big whack of shares coming from our partner Ateco, who's drilling aggressively at Pickle Crow. So we're going to see some great high-grade drill results coming out of them over the course of the next few months. I think when people come to realize what the combined Gold Lund Goliath project looks like in Treasury, we're going to see a significant re-rating of the Treasury stock. And a bunch of our shareholders, and Rory, you as a shareholder of ours, we're all going to become direct shareholders of Treasury Metals when we distribute some of our shares And our warrants next year, all the warrants we got in that deal, we're shipping out to the shareholders, and Treasury's agreed to list them both in Canada and the US. So you're going to get, a pretty big, and they're 3-year warrants as of August. So by the time they come out, you'll still have 2 years of, 2 years of time value. And I'm sure lots of volatility value in those, which are sitting right almost at the money right now. So, I think all of these things, will make some progress on some of the other projects that we have, demonstrate, like we did with Pickle Crow, like we did with Gold Lawn, that each of those other projects should be worth $50 to $100 million at least, and some of them I think far more than that. And then we've got $1.5 billion Canadian, $1.2 billion US of net present value at Springpole at a $1,500 gold price. You're still getting it for free. And this is one of the biggest and most robust development projects in the sector, located in a tier 1 jurisdiction. Like, it's irrational. So all we're going to do, it's super busy. We're keeping our head down. We focus on the fundamentals. We make sure that we're doing the right things in our communities. We make sure that we're doing the right things. We're now very well funded to get all of the technical work done that we need to get done, and get this project through the permitting process, because, it's important. It can change a generation of lives in and around its local communities, which is really important.
Yes.
And, I think we're heading into the environment where we're going to have this project ready to build at a time when the industry needs it the most.
I love everything that you just said, because you brought the community in, and like you pointed out, Dan, that's a huge part of any mining project. You've got to have the local community on board. They've got to feel, they've got to know that there's a benefit. They've got to know that you're doing the right thing by their environment, that you're not going to just dump create a giant cesspool and walk away. After you've extracted everything out of it, taken all the wealth and moved it somewhere else. They've got to be part of that. Yes. I mean, we've seen that when somebody, I'm not going to get into it, but we've seen what can happen when the local community doesn't agree with what's going on.
Yeah, isn't it? It just doesn't work. As right. Like 5 years as a private equity investor, we had big investments in Kenya, we had big investments in Lesotho, we had big investments in Brazil, we had big investments in Canada. And one very central theme to all of those investments was that no matter where you are in the world, your local communities need to benefit, and benefit materially, from the development of a project in their area. That's, yep. It kind of goes without saying that the industry, for those people who aren't invested in and spent their career in this industry like I have, it has changed enormously over the last even 10 years. And we thought we were pretty good stewards 10 years ago. It's changed enormously since then in terms of the understanding of exactly that and the importance of your social license. So, we still have a lot of work to do. We need to build and solidify a lot of those relationships with our local communities. But that's something that we're committed to doing. And we now have the capability to invest in those relationships in a way that was difficult for us to do over the last couple of years.
Yeah, and you guys are doing it. You've made the commitment, and that's what's important. That's and it shows in what you guys are doing. So, Dan, I could talk to you literally the rest of the day. I love talking to you. You have a brilliant mind. You're easy to talk to, and the projects that you're involved in, I'm really grateful for, because I think that you are going to create, once again, generational wealth. That's my personal feeling. This is not financial advice. I'm just saying this is what I believe, that's what has the potential to happen. And because I believe in what you're doing, and I certainly support what Keith Newmeyer is doing, what he's been doing over the years. We've been speaking with Dan Wilton, who is the CEO and director of First Mining Gold, and you can find out more at firstmininggold.com. And if you want to get involved in their stock, we've shown their live stock exchange, and you can find out more at TSX under the symbol FF, on the over-the-counter market here in the United States under the symbol FFMGF, and on the Frankfurt exchange under the symbol FMG. And Dan, thank you so much for all your time today. I really appreciate it. And I look forward to the next update, and hopefully we'll be talking about $2,500 or $3,000 gold.
Hopefully, I can look like the oracle that I've come across in the last 6 months. You know, we'll see. It's one person's view, but Rory, I really appreciate you taking the time. I always really love our conversations and appreciate the time and getting our message out to all of your followers. It's much appreciated.
Thank you so much, and like I said, another 6 months, and we'll pick it up right where we're left off.
Let's get it in the calendar. I'll look forward to it.
All right, buddy. Talk to you soon.
Okay. Thanks, Rory. Take care.